welcome back to the option series. So today's video, what we're going to be focusing on is the Greeks. So this is very important when trading options. So again, if you're using Thinkorswim, they all have it, all the platforms. But if you're following along on Thinkorswim with me, again, it's on the layout. They already have it. So delta, gamma, theta, and vega. So you could go ahead and click that, and then that's gonna kind of pre-fill these columns. So you can see delta, gamma, theta, vega. Again, bid and ask is when you're purchasing and then when you're selling. And so for this example, what we're gonna be looking at is this contract at 121 strike. So again, the strikes are the price of the stock that you're willing to pay for. So let's take this example. And so Delta, I'm gonna go over each one, and then each video, we'll see, we might put into separate videos, but so each uh, delta, what that means is it's the rate of change for every dollar Apple goes up. So I'm gonna go into examples of what that means on your actual contract price. Gamma is the rate of change of delta for every dollar it goes up past a dollar. So $2, $3, $4. Theta is time decay. So it's how much you're gonna lose on the contract each night. And Vega is just implied volatility. And you don't really have to focus on it too much. If you're longer term, then you just have to account for earnings. So the Vega might just be a little bit higher. So if the Vega is a little bit higher, then it just means that there's more volatility in your pricing. So let's just jump right into it. We're just going to start off with Delta. So for this example, we're going to be using again, the March 19th, 121 call. So again, you could go back earlier in this video, you'll see the numbers. So the contract, if you wanted to buy 121 call, you're paying $2.14. Again, you multiply that by 100 because it's going to equal 100 shares. So you're paying $214. So Apple is currently trading at $121.03. So the delta for this contract is 0.51. So again, $51 or 51 cents, depending on how you look at it. So again, delta is how much your contract will go up for each dollar the stock also goes up or down. So again, let's say Apple goes up a dollar and now it's trading at $122.03. So what that means is your contract that you initially paid $214 or $2.14, we'll say $214, is now going to be added to 51. So 214 plus 51 is going to be $2.65 or $265. It also works, Delta also works if Apple goes down. So say Apple actually went down to $120.03, you would actually lose 51 cents on your contract. So now your total cost for your contract would actually be worth $1.63 or $163 just because Apple went down a dollar. So you could kind of see the risk and reward. So now you're down $51, but if Apple went up a dollar, you would be up $51. Again, $265. And you, again, if you're happy with that $50 profit, you could go ahead and sell it, right? Because that's almost, you could say that's almost 20% roughly. And so what you can do is you could sell it, you could keep it. So again, that's up to you and your preference. So in the next video, we're actually going to go into Gamma.